The economy is doing well. We have confidence in the robustness of the economy and its resilience to shocks. It's performed well over the last several years. We've created, since the trough in employment after the financial crisis, 16 million jobs. The unemployment rate has moved way down and more people feel optimistic about their prospects. The message is the economy is doing well. The U.S. economy is performing well. It seems pretty balanced, so people can feel good about the economic outlook.
Signs that the U.S. economy is going strong. Wrong.
Yesterday, the Fed did exactly what everybody expected, and that was they raised the interest rates a quarter of a point. I don't think it's working out very well because they're working on a false notion that they have control, that they are significant, and all they do is manipulate things, building bubbles and setting the stage for these corrections. So I think that's what we're witnessing now, Daniel. This whole thing is emphasizing that Keynesian economics doesn't work, inflationism doesn't work, central banking doesn't work, and but you can't give up on that because there'd be problems. They might worry about who's going to pay for the debt and this sort of thing. The Fed would create bubbles, then they would deflate the bubbles, and then they would get interest rates lower. But they never look at the real problem of the misinformation they get from trying to find the right interest rate. And that's what this whole story was about. They don't know the right interest rate. They're just guessing at it. This is a sign that they never did have much control, and they're going to lose a lot more. And there's going to be some real surprises. And one surprise that I sort of lean strongly to is that there will be a lot of inflation for all prices. At the same time, the economy will be weak. They might call it stagflation. We didn't have a recent depression. It was just a super recession. Mm-hmm. In the same way with this. They're not going to call it, an inflationary depression, but that's possible. And the worst scenario for that would be things like Zimbabwe and Venezuela.
The economic forecast for 2017 is more than bleak. And there is more than enough economic data out there to show there could be a US economic collapse in 2017. Despite trillions of dollars in quantitative easing, the US economy remains fragile, and not even the euphoria, hype and optimism around President-elect Donald J. Trump will be able to resuscitate what President Obama left him.
Well, I'll tell you what, he has a short amount of time, and I think he's sincerely trying. And when he talks about taxes and regulation, I think he's doing a great job. But the whole thing is, let's say there are some dire predictions that, next year, or say a year and 18 months, we have something arriving worse than 2008 and 2009. The downturn is much worse. And they'll say, it's all Trump's fault, it's all Trump's fault. No, it wasn't. 08 and 09 wasn't Obama's fault. It was the fault of the Federal Reserve. It was the fault of the Keynesian economic model, the spending too much, the deficit. So unfortunately, there's nothing he can do. Trump can't do it. He can help, by some of these policies, but you can't avoid the correction.
US unemployment is not 4.6%.
94 million Americans are out of the labor force. Over 43 million people are now living in poverty, and over 43 million Americans are on food stamps. More than 1 in 5 people in their prime working years are not working.
There has been a lot of hype about how the unemployment rate has improved over the last number of years, from around 10% in early 2010 to 4.6% in November 2016. And frankly, having the unemployment rate at just 4.6% is pretty incredible. Unfortunately, it isn't really true, or rather, it is if you don't look at the data provided by the Bureau of Labor Statistics, the BLS. Consider the November jobs report. According to the BLS, the unemployment rate fell to 4.6%, and 178,000 new jobs were created on the surface. This sounds amazing, and perhaps President Obama deserves another Nobel Prize. But it isn't, and he doesn't. The unemployment rate does not include discouraged workers who cannot find jobs and have stopped looking, and those jobs that were created are not what they appear either. First, let's look at the actual unemployment rate. The improved jobs data comes as a result of new jobs. More on that later. And partially due to those retiring or leaving the workforce. The unemployment rate is down so much because the number of Americans not in the workforce soared by 446,000 in November to a record 95.1 million. The participation rate hit 63% in March and has been struggling since then. In November, it was 62.7%, a little shy of the October 2015 all-time low of 62.4%. Added up, and the overall unemployment rate is 9.3%. What about the jobs being created? Of the 178,000 jobs created in November, only 9,000 are considered to be full-time jobs, defined as 35 hours or more per week. The rest are part-time, and most of those are low-paying. The demand for waiters and waitresses remains strong, with food services and drinking places adding 19,000 jobs. US unemployment may be low, but it isn't because the US economy is strong and creating secure, well-paying, skilled jobs. Wage growth is down and the demand for low-paying, part-time jobs is up. And economic recovery and strong jobs growth? Not yet. US inflation is stretching American households.
We have the highest inflation in 5 years. It doesn't sound like things are on track. Look, Janet Yellen is always going to try to put a positive spin on everything. But the reality is the economy has barely been growing. And in fact, I think if the government was more honest about the inflation rate, we would have seen that we actually have been in a recession. That's why Donald Trump was elected president, because the economy was so weak.
Another reason to fear US economic collapse is inflation. Consumer prices rose for the fourth consecutive month, and the Consumer Price Index, which measures what Americans pay for everything, increased a seasonally adjusted 0.2% month over month. Prices climbed for gas, rent and used cars, but declined for groceries and clothing. On a year-over-year basis, overall prices were up 1.7% in November, the strongest annual gain since October 2014. The upbeat data, no doubt, gave the Fed the encouragement it needed to raise rates for just the second time in a decade in December. Against a backdrop of weak jobs creation and wage growth, 1.7% inflation doesn't sound like that big of a deal, but it is, because 1.7% isn't the real inflation rate. To get a feel for what Americans are really paying, it's a good idea to consider the Chatwood Index. The Chatwood Index is an alternative non-government measure that looks at unadjusted costs and price fluctuations of the top 500 items we buy: insurance, gas, coffee, dry cleaning, movie tickets, etc. In the 50 largest cities in the US, thanks to the Chatwood Index, you can see what people around the US pay for the same products and track the change in living costs. For example, in New York, Los Angeles, Chicago, Philadelphia, San Diego, San Jose, San Francisco, Seattle, Boston and Detroit, the 5-year average for inflation is over 10%. Even if you lived in Colorado Springs or Wichita, the cities with the lowest inflation rate, where the 5-year average for inflation is around 7.5%, your cost of living is still significantly higher than the official rates. No matter where you live in America, inflation is seriously outpacing what you make and, chances are, putting more and more Americans in debt. More and more Americans in debt and out of money.
Over 43 million people are now living in poverty, and over 43 million Americans are on food stamps. More than 1 in 5 people in their prime working years are not working. We have the worst financial recovery in 65 years. In the last 8 years, the past administration has put on more new debt than nearly all of the other presidents combined.
7 years into the so-called US economic recovery, prices are up and Americans are making less, are in debt, and have little set aside for an emergency. For an economy that gets more than 70% of its GDP from consumer spending, this is not a recipe for economic success. Case in point, over the last decade, US household debt has soared 11%, with the average household owing $132,529. Total US consumer debt in 2016 is expected to ring in at $12.5 trillion. This would trump the total debt of $12.37 trillion in December 2007, when the Great Recession started. It's getting harder and harder to pay that debt off too, even according to official data. Over the last 13 years, the cost of living has increased by 30%, but household income is up 29%. The most expensive debt, credit cards, cost the typical household $1,292 annually in interest charges, with interest rates expected to rise 3 times in 2017. That debt burden is going to get even worse. The debt burden has put a strain on American households. Almost half of Americans, 47%, if they had an emergency expense of just $400. Is it any surprise close to 46 million Americans receive food stamps?
You know, we look like a middle-class family, probably. You know, we have 2 kids, we have 2 cars. I have a master's degree. I have a college education. My husband is a military veteran. He served 2 tours of duty, once in the Army National Guard and once in the Navy. He served under Desert Storm and Desert Shield. And yet we're faced with the prospect of moving back into a motel room. Like I said, we're going through an eviction. We've had our electricity cut off. We have a place to live right now, but it just doesn't have electricity. And you know, you don't realize how much you take for granted until you go to wash your hair or you go to blow dry your hair. You know, when you go to flip a light switch, you know, or you think, okay, well, I can't cook anything because my microwave's not working because I don't have electricity. We've had to store food at a neighbor's house so that it wouldn't go bad. And I've heard people tell stories of their electricity being cut off for weeks. And I think, how do they survive?
When a child in a family has been evicted from a home and they want to say, it's time for us to go home. And then when they realize there's no home to go to, they begin to cry. And at times, they have sought refuge. And they're crying and their tears and cried themselves to sleep because they miss a warm, comfortable bed, but now they may be in a cold car wrapped up in blankets and they're crying themselves to sleep because their little heart hurts. There's no home anymore and they miss it.
I wouldn't feel comfortable begging, you know, but I see people on the street corners and I don't judge them anymore, because when you do that, then you take the face off of poverty. You take the face off of the working poor family. And when you don't have a face on it, it's easy to shove it under the rug.
We started all this mess in the 30s, and it took all the 30s and World War II to rearrange things, liquidate the debt, and then they went back to economic growth again. And that's what we're doing now. I mean, it's the past 8 years have been horrible, and these statistics shows that it's a very weak economy, much weaker than anybody wants to admit. The GDP is just, not growing. I mean, debt is growing tremendously. tremendously, but not the GDP.
In fact, we have a great chart that shows this. We talked about this before the show. The red, of course, is debt, and the green is GDP growth.
You know, why I think this is a magnificent chart, it proves my point, and it's a great picture, because the interventionists, the planners, the Federal Reserve, the Keynesians, the big spenders, the people who believe in debt, believe in the red line that is the salvation. This is what you do. You print money and you pay all the bills, but guess what happened? Debt goes up, but they don't get the growth. It isn't translated into growth, and that's what that green line.
More and more Americans are relying on part-time jobs, which pay poorly, and getting themselves further in debt. And the Federal Reserve is adding some fuel to the fire in the form of rate hikes. After years of artificially low interest rates, the Federal Reserve is starting to raise rates. While it's high time the Fed raised rates, it waited too long, and the repercussions will create another US economic crisis. Low rates were designed, in principle, to help kickstart the economy. Banks offered cheap money, Americans borrow and spend, and voila! The US economy is on fire once again. The low interest rates were great news for those with a mortgage, loan or credit card, but in a low growth environment, that interest rate hike could cripple the US economy. In December 2015, the Fed raised its key lending rate for the first time in a decade. It was a small hike, but it showed consumers how even a small increase affects mortgages, car loans, saving rates, and other forms of interest-sensitive credit. In December 2016, the Fed raised rates again by 1/4 of a percentage point to a range of between 0.5% and 0.75%. Federal Chair Janet Yellen said the economy has proven to be remarkably resilient, and that the hike is a vote of confidence in the economy.
Our decision to raise rates should certainly be understood as a reflection of the confidence we have in the progress the economy has made, and our judgment that that progress will continue, and the economy is proven to be remarkably resilient.
But is the US really strong enough to withstand another rate hike? The US economy continues to face a lot of headwinds, including weak global economic conditions, high household debt, and a lack of well-paying jobs. The US economic outlook is somewhat muted as well. In a best-case scenario, the Fed believes the US economy advanced 1.9% in 2016 and will advance 2.1% in 2017, assuming the US economy grows as anticipated. The Fed will raise rates 3 times in 2017, ending the year with a rate of 1.4%. Again, that's assuming President-elect Donald J. Trump's economic action plans will send the US economy into overdrive. No matter how admirable, Trump's plan to cut taxes and increase spending when the national debt is already at $20 trillion will be hard to achieve. Weak economic growth coupled with rising interest rates could cobble the US economy and send it back into recession.
This is a complete bubble that the Fed has blown. Trump was right when he was a candidate. It's a big, fat, ugly bubble. It's even bigger, fatter, and uglier now. And it's not just the stock market. And by the way, the bond market bubble has already burst.
US benchmarks are trading at record levels, and Wall Street couldn't be happier. After a terrible start to 2016, equities rebounded with an S&P 500, finishing the year up nearly 10%. The Dow Jones Industrial Average soared 13.5% in 2016, while the Russell 2000 Small Cap Index was up 20% in 2016. The long-in-the-tooth bull market is about to enter its 9th year, and analysts remain adamant that a bull market, the second oldest in history, could go on for years. Sadly, the bull market isn't based on once tried and true fundamentals like earnings and revenue growth. The current bull market was born on frustration. The Federal Reserve took income out of fixed income investments when it introduced the first round of quantitative easing and gutted interest rates. 4 rounds of quantitative easing and artificially low interest rates may have helped those with money make even more money, but it decimated the retirement plans of those who relied on fixed income investments like certificates of deposits, bonds and treasuries to provide them with steady income and help them through retirement. But with returns hovering near zero, the only place left for investors to park their retirement money was in stock market. Over the last 9 years, investors have sent stocks higher and higher, despite weak earnings and revenue growth. On the surface, that's good news for those with their money in stocks, but it's also pushed valuations into nosebleed territory. And should the US experience an economic crisis in 2017, you can expect stocks to hit a brick wall and crash. How far will US equities fall? According to the Case-Shiller-Cape PE ratio, the S&P 500 is overhauled by 73%. The ratio is based on average inflation-adjusted earnings from the previous 10 years. The 100-year median is around 16. The ratio is currently at 27.80. This means is that for every $1 of earnings a company makes, investors are willing to fork out $27.8. The ratio has only been higher twice, in 1929 and 1998-99. Another economic indicator also suggests US stocks are significantly overhauled. The market cap to GDP ratio, which compares the total price of all publicly traded companies to GDP, is also called the Warren Buffett indicator, since the Oracle of Arma calls it the single latest measure of valuations. A reading of 100% suggests US stocks are fairly valued. The higher the ratio is over 100%, the more overhauled the stock market. The market cap to GDP ratio is currently at 126.9%. The Warren Buffett indicator has only been higher twice since 1950. In 1999, it came in at 153.6%, and in late 2015, it was at 129.7%. It was only at 108% before the 2008 financial crisis. Over the long run, stocks' returns are determined by interest rates, corporate profitability, and valuations. Interest rates have an inverse relationship to stocks. If the return on risk-free government securities is higher, there is less of a desire to invest in riskier assets like stocks. If interest rates go up, stocks typically go down. Conversely, as we've seen, in an artificially low interest rate environment, stocks soared. As for corporate profitability, when the economy is doing well and companies report strong earnings growth, their share prices rises. During a recession, profits slip and share prices are penalized. That hasn't happened this time around. Stocks have continued to climb even in the midst of an earnings recession. Investors have also rewarded companies with higher valuations simply for not losing as much money as they thought they would. Ideally, stocks and their valuations would follow the mean. But as we've seen, stocks and valuations are not running in step. Stocks are significantly overhauled, and there is every reason to believe the US will face an economic crisis in 2017, and stocks will collapse. Interest rates are going up. Corporate profitability is anemic. The US economy remains fragile. Global growth is underwhelming. Americans are unable to find good jobs. The participation rate is near record lows. Americans are deep in debt and have little to no emergency fund. An economic collapse would mean Americans cut back on spending, which would undermine overvalued stocks, leading to another stock market crash.
There will be a lot of inflation for all prices. At the same time, the economy will be weak. They might call it stagflation. We didn't have a recent depression. It was just a super recession. In the same way with this, they're not going to call it, an inflationary depression, but that's possible. And the worst scenario for that would be things like Zimbabwe and Venezuela.